AMC currently up 5.5%, and we were just confirmed in a technical recession. Yes, we have seen 2 consecutive quarters of declining GDP growth. We just got that data that came out about 45 minutes ago, so we're going to talk about that as well as what is going to happen throughout the rest of the day today. That is going to change the game for 2022. You have over 10% of the S&P 500 and over 15% of the NASDAQ weighting that is reporting earnings here in after hours. So guys, let's get straight into it. We're going to get into everything AMC, everything broad markets you guys need to know. If you guys are into that kind of thing, making money, hit that like button and subscribe to the channel. If you guys want to come trade with me live in real time, link down below in the description of this video. Nonetheless, leave your comments down below. What do you guys think about these earnings and after hours? What do you guys think about this technical recession? So that's the first thing that we are going to talk about is the technical recession. And yes, GDP fell by 0.9% in the second quarter, the second straight decline, and a strong recession signal. Key points: gross domestic product fell 0.9% at an annualized pace for the period, according to advanced estimates. That follows a 1.6% decline in the first quarter and was worse than the Dow Jones estimate for a gain of 0.3%. The decline came from a broad swath of factors, including decreases in inventories, residential and non-residential investment, and government spending. And it goes on to say that right here, officially, the National Bureau of Economic Research declares recessions and expansions and likely won't make a judgment on the period in question for months, if not longer. So recessions, believe it or not, are actually a lagging indicator. By the time the Bureau says that you are in a recession, you're usually almost out of a recession, right? Think about COVID, right? Nobody said we were in a recession until the stock market had recovered. We were well out of a, recession. So we're probably not going to get confirmation that we're in a recession. And you could put that in big air quotes here, but you've never not had a recession when the GDP fell 2 consecutive quarters in a row. Now, the markets are taking this kind of bullishly today. And why is that? Why would the markets take that bullishly? Well, long story short is that the worse the economic data gets, the less the Fed will raise rates. At least that's what market participants are expecting. Now, the Fed actually wants a small recession. So this actually works against the Fed by trying to say we're not in a recession. Guys, calm down. That's basically what the White House is saying, trying to change the definition of a recession. Because when you're declared in a recession, what happens? Well, interest rates fall. The cost of capital becomes cheaper. It becomes less expensive to borrow capital to invest in the markets, buy a house, buy a car, so on and so forth, to spur economic activity. But it also brings down inflation. So what we could see right here is that what is happening today is let's go ahead and pull that up. Oil is up 1.37%. It's because we're not in a technical recession. Now, if everyone thought that we are in a recession, well, the price of oil would fall off of a cliff. Let me show you guys what happened during 2008. It's like clockwork, right? Oil peaked out $140 a barrel, and then what happened? You were declared in a technical recession, and it fell all the way to $44.60 for a barrel of oil. It's because people expect deflation, people expect less demand, and that is what is good for inflation, and that is what will make the Fed stop raising rates as aggressively, and that's the key point. So actually, a small recession could be bullish, but what you're seeing in the bond market is investors are playing along with the recession narrative, right? So you're getting a little bit of a mixed bag here with bond yields that are dropping about 6 basis points today. A US 10-year bond now paying you 2.672%. The worst case scenario is we drag this out. The economic data continues to get worse, but inflation stays high because we're not in a technical recession, and those recession deflation factors don't come into play. So long story short here, there's a little bit of a push and pull. The bond market starting to price in this recession, stock market absolutely not pricing in a recession as of right now. And a lot of people are just not even calling this a recession. Look at the White House. They're saying we are not in a recession. So we'll see how all of this does play out. The biggest things you guys need to know for the day and what you should really pay attention to is Apple and Amazon earnings. Yes, in after hours, you have Apple, Amazon, Roku, Intel, United States Steel, KLA, Edwards, Dexcom, Hercules, and Yamaha Gold. Those are the bigger earnings. There's other earnings, but those are the ones that the markets care about the most. And obviously, Apple and Amazon right there, that's 10% of the S&P 500 weighting. So for an example, if Apple and Amazon fell 1% apiece, that would bring down the S&P, in theory, 0.10%. If Apple and Amazon fell 10% apiece, that, in theory, would bring down the S&P alone 1%, not to mention just other stocks that would fall in a sympathy to those earnings. So that's why it's so important. Apple controls 7% of the S&P and Amazon controls over 3% of the S&P. For the NASDAQ, Amazon controls over 5%, Apple controls over 12% of the NASDAQ weighting. So it's very important. And if you want to gauge the consumer, forget what the GDP is saying. Forget what the Fed has to say. Forget what these so-called economists or the White House have to say. Look to Apple and Amazon earnings. You have seen Facebook come out yesterday and say, Zuckerberg, the lizard guy, right? He's come out and said that we are in a slowdown. So Facebook has to do more with less. They said the economic downturn is already here. And you're seeing that across the board. Everyone is saying consumers are slowing down. Look at Walmart. Came out and cut their guidance before earnings. That hasn't happened for 10 years, right? Doesn't happen that often. Apple, Amazon, those are the ones I'm most concerned about for this earnings season, and I have stressed that to you guys quite a bit here on this channel, but I just think there's not going to be as much demand as investors hoped, and we're not going to see that growth at Apple and Amazon that we are used to seeing over the last 2 years, and that could really scare a lot of investors. So there you guys have that. That is the biggest thing that you guys need to know. We do have some economic data as well that will be important to point out. So for the day, the big thing was the GDP report. And that's obviously, the biggest thing for the day. You have other things that came out as well, but you're not going to hear anything about that. That's not going to affect the markets. On Friday, you do have personal spending month over month for June, comes out at 8:30 in the morning. So tomorrow, personal income month over month for June. PCE price index, employment cost index, that's something the Fed specifically said they want to pay attention to. Employment cost, wages, employment cost, benefits, core PCE prices, Chicago PMI, Michigan consumer sentiment surveys, Michigan current conditions for July. So you got a lot of data that is actually coming out tomorrow, a lot of which will be important. And basically what the Fed says is they will go more aggressively if they have to, or they will go less aggressively if they have to. That it all depends on the data. And that's why all these individual data points will be so important, because it will also move the Fed funds rate, the expected Fed funds rate for this next upcoming meeting in September. Keep in mind, we do not have a Fed meeting in August. We are expecting to get a 50 basis point rate hike. This 3 to 3.25% right here, that would be a 75 basis point rate hike. So what we're expecting right now, 50 basis points. If data comes in, really strong, inflation really high, then we will get a 75 basis point rate hike, and the markets are going to pay a little bit more attention to that. We didn't get any clarity as far as a U-turn from the Fed, but they did leave it up to the data. So if the data looks good, that's just how we're going to trade, right, off of these data points. Now, the markets are falling right now, which is not surprising. Over the last two FOMC meetings, you have rallied after Fed Powell speaks, and then you have crash the next day to give back all of those gains. So it wouldn't surprise me to do something along the same lines, but I would imagine that today Apple and Amazon, just the anticipation of those earnings, will keep the market somewhat stable. Even if we did drop 1 or 2%, it's not the 3 or 4% that we're usually used to seeing after the FOMC meeting and the Fed raising rates. But nonetheless, depending on what happens with Apple and Amazon, that will change the game for the stock market here, at least in the short term. Now, as far as the dollar amount of dollars that are currently sold short of AMC stock, we're sitting at 1.46 billion. Estimated short interest of free float at 19.56%. Free float out on loan 27.93%. Shares out on loan 143.98 million. Days to cover 3.41. Cost to borrow 9.8. 100% share utilization. Cost to borrow average of 9.35%. Cost to borrow max of 12.51%, and cost to borrow minimum of 8.84%. Do not forget, these are very large numbers. Even a 19.5% short interest is a very large number. A 8% cost to borrow minimum is not cheap, especially when you're talking about millions and millions of dollars. So I think people tend to forget that. Something you don't want to forget, because that starts to eat away at these hedge funds. Now, take a look at this very large order that came in. A January 19th, 2024 $10 call. They did pay $7.83 in premium, so that would be a break even of $17.83. And they spent $1.5 million. And yes, that is a call. So what you're actually seeing right there is somebody that wants, to buy these options in the money, and that they think AMC stock is going to move big to the upside, right? This is what I would expect to see out of hedge funds, is to go deep in the money with a very large amount, 1.5 million, expecting a big move up. This is how I would expect them to make these trades. And this trade actually came in about 45 minutes before the end of trading yesterday. So I think that does imply potentially some bullishness for AMC in the next couple of weeks, if not the next couple of months. Specifically next week, August 4th, when AMC reports earnings, that is going to be the day that you want to watch if you are an AMC investor. Now, for the day, the positive order value for option activity is sitting at 57%, 12 orders totaling $3.71 million. So nonetheless, pretty damn bullish what we're seeing right there. S&P 500, not so much. If we pull up AMC on a daily candlestick chart, you guys can see today, we're still positive, up 2%. We were up 5% just a couple of minutes ago when I started recording this video. But we did come down a little bit around the 50-day moving average, found some support around that, a real good demand level, and then we did come up to the 100-day moving average and actually got rejected almost on the dot of where the 100-day moving average is. Now, if we can close above 15, that's going to be very good. If not, it doesn't matter to me all too much, because Apple and Amazon, those are going to be the stocks that really dictate what's going to happen over the next couple of days, if not the next couple of weeks. I will say, though, and I think this is important to point out, Apple has seen a major rally into earnings. Usually, if you see a major rally into earnings, something that is this important, it doesn't take a lot to see the stock essentially come down, right? If that demand is showing in Apple, that their demand is slowing down, well, that's going to be a very bad situation all the way around. And as far as AMC on the RSI, that's sitting at 50.31, so at the neutral level, and the MACD is now really bearish. So that's going to be it. Hopefully this provided you guys some context, if not information. Thank you guys for tuning in. Hit the like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with me live in real time, link down below in the description as well. You guys enjoy the rest of your days, and I will see you in the next one.